What do you think matters the most to investors? How much income they earn or how much they get to keep after taxes? I think most of you would agree it's the latter. There are three types of investment income: interest, dividends, and capital gains. Consider novice investor Jack, who just learned that his portfolio generated $10,000 of investment income last year. Right now he's thinking, I just earned $10,000. What the heck do I care what type of income it is? Well, the type of investment income he earns could impact the amount of taxes he'll have to pay on that income. Now, I'm not saying that the type of income that an investment generates is the be-all and end-all, but it is an important consideration when selecting an investment. Each type of investment income is taxed differently and for good reason. The tax system is designed to encourage investment in the economy. Suppose that Jack deposited his savings into a bank account. He's not really investing in the bank, is he? He's just lending money to it, for the time being, in exchange for some interest. Compare that to Jack buying the bank's common shares, which would make him a partial owner of the bank. If you don't know what a common share is, don't worry. We'll revisit that in another lesson. There's more risk when investing in common shares, but there is also a greater potential reward. If the price of the common shares increase, he could sell his shares for more than what he paid for them and earn a capital gain. In addition to this, while he owns the shares, he may be entitled to a share of the company's earnings paid out to shareholders, referred to as dividends. On the other hand, if he winds up selling the shares for less than what he paid for them, he would suffer a capital loss. As you can see, someone who deposits money into a bank account could be thought of as a saver, whereas someone who buys the common shares of a company is an investor. The government wants to encourage investment because it creates jobs and helps companies grow, both of which result in greater tax revenues. So in general, interest income attracts the most tax. Capital gain income attracts the least tax, and dividends from Canadian companies typically fall somewhere in the middle. Let's go through an example. Assume that investor Jack is in a 40% marginal tax bracket and earn the following amounts of investment income: $1,000 in interest, $1,000 dividends from a Canadian company, and $1,000 in capital gains. Let's figure out how much tax he would owe. We'll start with the taxation of interest income. Now recall that depositing money into a bank account or even a bank-issued guaranteed investment certificate isn't investing in the security's issuer. The investor is simply lending his money in exchange for a certain interest rate. The government doesn't offer any kind of tax break with this type of investment. If he earned $1,000 interest, the full amount would be subject to tax. $1,000 times a 40% marginal tax rate equals $400 in taxes. This means his after-tax return would only be $600. Now let's talk about the capital gains he earned. Jack bought a company's shares for $10,000 and eventually sold them for $11,000, thereby earning a $1,000 capital gain. Now, as I previously mentioned, the government wants to encourage investment in companies and therefore gives a pretty good tax break when it comes to capital gains. Only half of a capital gain is subject to tax. We would calculate the tax as follows. The difference between the $10,000 he purchased the shares for and the $11,000 sale price resulted in Jack earning a $1,000 capital gain. Recall that only half of a capital gain is subject to tax. So we take the capital gain of $1,000 and multiply it by 50% to get the taxable capital gain of $500. We then multiply the $500 taxable capital gain by his marginal tax rate of 40% and determine that he would owe $200 in taxes. This means his after-tax return would be $800. Now you want to be careful with the terminology here. If you were asked, what was Jack's capital gain? The answer is $1,000. If you were asked, what was Jack's taxable capital gain? The answer is $500. And finally, if you were asked, how much tax would he owe? The answer is $200. Let's recap what we've learned so far. On the $1,000 interest income, he would owe $400 in taxes, resulted in an after-tax income of $600. On the $1,000 capital gain, he would owe $200 in taxes, resulting in an after-tax income of $800. So take note of the following points. Interest income attracts the most tax. He paid half as much tax on the capital gain. Capital gain income attracts the least tax. Now, dividend income from Canadian companies typically falls somewhere in the middle. Now, I appreciate the fact that you may be thinking, I'm not even sure what a dividend is. So in the next video, we will discuss what dividends are before addressing how they're taxed.